This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We went through it very quickly, but I hope it made sense. That example, which was it? Example 9, was it? 10? 9. Example 9. The company was financed using debt, using equity. I hope you were all clear. Always you work out the cost of each individual bit separately. Equity is only ever going to be using the formula. Alright, I said at the time, here I deliberately made it the easiest I could because it was constant dividend. But even with growth, well, we'd done enough earlier, I think easy enough. But work out the normal way. Cost of debt, again, completely separately. Here, again, very quick because it was irredeemable. Had it been redeemable, 2 guesses approximate. It takes longer, but we've done it. Hello? Hello? Once you've got the cost of each bit separately. Again, I did do it quick, but I hope it made sense. We just take the weighted average. But always, 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 it's the weighted average based on the ex-div, ex-interest market values. All right? So the total market value of equity, the total market value of debt, and then the weighted average. Now, we'll talk later about the significance of that figure, the importance, and it's an important discussion. For the moment, though, just as an arithmetic exercise, are all 3 of you clear how I arrived at that 12.51? I say we'll discuss the relevance after, but I'd be wrong if I said it's every exam, but it's virtually every exam that somewhere you'll be expected to calculate the weighted average cost of capital. Sometimes it's very quick, you know, like that one, and not too many marks. Sometimes it's longer. Obviously with growth, if you're estimating growth rate, redeemable debt, it takes longer and it's more marks. But it's almost every exam you would need to calculate that. Okay? And because it's so important, well, and we're going to do 2. First of all, can you turn to example 10? Oh, incidentally, sorry, before I do, although any time you're asked to do it, there will be equity, there will be debt. I mean, I think it stands to reason if there was only equity, you'd no work. You know, if there was only equity in this company, if it was all equity financed, cost of equity is 14.68. If there was only equity finance, the weighted average cost of capital would be 14.68. You agree? So in every asset, there's always debt and equity. There could be more sources. For instance, you could have 2 different debt borrowings. You know, there could be equity. There could be, 3 million borrowed from 10% debt with this market value. There could be another 2 million borrowed from a different debt. You are understanding me? Well, no problem. Takes a few minutes longer. But whether there are 2 sources, whether there are 10 sources, you work out the cost of each separately. You then work out the weighted average, the way we've done that, based on market values. All right? There'll never be 10. That would be ridiculous. Usually only 2. There may be 3. But I hope you are understanding me. Apart from it taking slightly longer, there's nothing extra to learn. However, as I say, because it's important, I want you to do 2. First of all, can you look at example 10? K PLC is financed as follows. Equity, well, you can read the detail in a minute, but dividends are growing. It's not hard, Davita, don't run away. No. Debt, again, read the detail in a minute, but they're redeemable. You'll have to get the internal rate of return. They want the weighted average cost of capital. So can you ever go, what's the cost of equity? What's the cost of debt? And then the weighted average. I don't want to waste time, so check as you go along, please. I'll write it on the screen. Anyone can make a silly mistake. When you've got your cost of equity, check. If you're different and it's not obvious why, ask me. When you've got your cost of debt, check. And then weighted average. Okay? As fast as we can. I'll leave it switched on a minute, but I hope you'd all check the cost of equity. I've had to wind forward. So everybody, cost of equity? Hello? That was just using the formula, cost of equity 40.75. Cost of debt obviously takes that bit longer, but really, I mean, do practice. Because once you've got it, it shouldn't take many minutes. Do remember, and I did say last time, that because in fact it's not linear, any answer you get is only approximate. And so I always guess at 10% first because it's the middle of the tables. And then either 5 or 15, I've done 5. If you guessed at different interest rates, if for instance you'd guessed at 12% and 7% or something, you will get a slightly different answer. Do you remember? But you'll still get full marks. So I don't know if any of you did do it at different rates. If you're more than 1% different, something's almost certainly gone wrong. But you won't get precisely 7.51. You don't lose any marks, it's irrelevant. And of course, anyway, when you come to do your weighting, any difference in the final answer becomes even smaller, if you're with me. So do bear in mind, if ever you're doing ones at home and checking them, if you've had different guesses, you will end up slightly different, but you'll still get full marks. Clear? But otherwise, well, I got 7.51. The weighting itself, I hope is clear to everybody, always it's by total market values. The weighted average is 13.56. All right? And although, as I said, it's something we do need to discuss shortly, occasionally, there's nothing to write, occasionally, that's the discount rate if we were looking at a new project. If I told you there was a new project, cost $1 million, gives us these returns, occasionally you'll discount at the weighted average cost of capital of here, 13.56. All right? However, not always. That we need to discuss later. But I better mention, I said last time, any discounting, he'd only ever expect you to use tables, and the tables only give whole rates of interest. If we were going to discount a project at the weighted average, you work it out properly and leave the answer. But if you then came to do any discounting using it, you'd do it to the nearest percent. So if you were expected to discount anything at that, it would be at 14%. Clear? Finally, before I let you see an exam one, there's one thing the examiner does which I think is the most ridiculous. It really annoys me, this. I don't know why they do it. You may have noticed, if you haven't, you certainly will, there is a formula on the formula sheet for the weighted average cost of capital. Just look at your formula sheet for a moment. It's 3 up from the bottom, and you don't need to write this down because you've got it in front of you, but it says WACC, weighted average cost of capital, is VE over VE plus VD times KE, VD over VE plus VD times KD, 1 minus T. Now, they give that on the formula sheet, but what is so annoying, I'll explain the symbols in a moment, what is so annoying is that, first of all, I think that makes things look complicated, where weighted average, I mean, good heavens, you all understood what I did there. Everybody? I hardly think you need a formula to tell you how to do what I did there. But secondly, the formula doesn't always work. I mean, the symbols here, VE and VD, I really wouldn't bother writing down, but VE and VD are the market values of equity and debt. E for equity, D for debt, I'm sure you can guess. KE is the shareholders' required rate of return. The KD is the debt lender's required return. And T, of course, is the tax rate. And so although it makes it look more complicated than it is, VOE over VE plus VD, surely, that's the weighting. Market value of equity 32 over equity plus debt. You with me? So it's basically doing what we did, but not only do I think that makes it look complicated when it actually isn't, you know, but in fact, that formula doesn't always work. That formula wouldn't work in the one we've just done. Why? Say again? Yeah, but so why does that cause a problem? Yeah, the point is, and I wrote down earlier, you see, the weighted average really is the weighting, equity over total, debt over total, time, the weighting of cost of equity. Well, no problem. The cost of equity is shareholders' required return, KE. The two are the same. Plus, the weighting for the debt, VD over VE plus VD, times, well, what it should be is the cost of debt. And I said to you earlier, and you wrote it down, if the debt is irredeemable, the cost of debt will be the return to the investor times 1 minus T. Look back to the previous example, or the one before. But if the debt's irredeemable, then that's just not true. The cost of debt isn't KD times 1 minus T. If it's redeemable, the cost of debt, you've no choice. You have to do the internal rate of return. You clear? The formula doesn't always work. I mean, it's completely mad. And the examiner does what I've done. In his answers, he does it properly. In this example we've just done, you couldn't use the formula. You've got to work out cost of equity, cost of debt separately. And then you take the weighted average. And the examiner does exactly what I've done there, because that's correct. He ignores his own formula, because his own formula doesn't work most of the time. All right? Which I think, I mean, I really think he's a complete idiot. And on top of that, as I say, I really think that of all the formula on the formula sheet, that's the one place you don't need one anyway. I can't believe, I mean, anybody might have problems with cost of equity or particularly cost of debt. That's practice. But I can't believe that anybody with a brain doesn't understand what I've done with weighted average. You know, you can make silly mistakes, but I don't think you need to look on a formula sheet for a formula, whether it were right or wrong. Yeah? You know, even just the time it wastes turning back the pages, I think it's just stupid. And so, for heaven's sake, ignore that formula. You never, ever, ever need that formula. Whether it's redeemable or irredeemable. We've just done two. I didn't use the formula for either. I really think if you need a formula, things are getting rather desperate. I think you need to have a word with me later, if you're not clear the logic of what I did. All right? Are you with me? Sorry, it's not my fault, Ilse, that the examiner is strange. I mean, he inherited it. I mean, that formula's been on the formula sheet for the last 20 years. And no examiner has ever bothered doing anything. They've left it there. And yet in their answers, they always ignore it because it's wrong. You know?